Hello, it's Thursday, the 13th of March, 2008. This is Brian Shannon from AlphaTrends.net, and let's start today's lesson with a reminder in what a bear market looks like. This is a bear market, the S&P 500 we're looking at right now. And the last time we saw a bear market develop in late 2000, the market ran for 2.5 years to the downside. Long before this market was this bear market was over, there were hundreds and thousands of calls for that was the bottom. There will be likely as many calls for that was the bottom in this market. No one can pick the bottom. No one can tell you exact turning day until well after the fact. You can point to it here and say that was the bottom. And if you bought on that day where it made that bottom, you probably tried to buy on this bottom and this bottom and this bottom, etc., all the way down. The trend is your friend for a reason. It takes a while to turn this thing around. At a minimum, you need to see the longer term, that is on the weekly time frame, the 40-week moving average, flatten out and see the market get back above that, then see that 40-week or 200-day moving average turn higher. So the fact remains we're in a bear market. That's the overall big picture. The encouraging sign is that we saw a real big rally on Monday. Yesterday we saw a little bit of profit taking up near the level that I had pointed out, which was the volume-weighted average price since the lows in January. So that remains an important level here up near 134 or so. If the market can somehow get back above that, well, we've still got to contend with, of course, this declining 50-day moving average, which indicates the sellers are still in control. Short term, though, we saw a big volume up event on Monday, and today we saw a market rally. The headline wasn't as big as Monday, but today was more important in my opinion because it started out with a lot of bad news, looking like it was terrible, looking like the end of the world, but the market was able to turn back around. And we look at the 3-day chart, which is what I had pointed out on my blog right about this point, that this is the average price. This is a moving average of the last 3 days of trading, the volume-weighted moving average of the last 3 days of trading, and it's updates dynamically throughout the day. And before the S&P 500 got above this level, the Nasdaq was already above it, and more impressively was the strength in the IWM that we'll look at. But what this tells me is when it moved back above this level here, and you can see that it was tested and did act as resistance, the market sold off a little bit, then it made these higher lows and higher highs. But prior to that post too, I pointed out in here the very big volume. It was actually right, let's just take a, well, hold on. It was right here that I pointed out the very big volume of this move, figuring that it was worth, it's worth noting, something worth watching. The market rallied up to that 3-day average volume price, and that's where the buyers took control. Now, that's the encouraging signs that over the last 3 days, price has memory, the participants have memory, and basically people are feeling semi-good about their purchases that they've made over the last 3 days. It looks like the market survived a pretty good shock below that 5-day moving average. And what we were looking for the last couple days was a pullback down towards 131. And I was saying that you don't want to buy on the way down to 131 instead, because you never know if it's going to continue to go lower, like it did here on the open today. And foreseeing this was anyone's guess basically. But the market did recover nicely. And what I'd said yesterday is that we want to look at these potential levels of support. For instance, near that 131 level in the 5-day moving average. But then don't buy there, but wait for evidence like we saw on the 1-minute time frame and then on the 3-minute time frame before you do any purchasing of high-risk long trades. Again, we're in a primary downtrend. Any trade to the long side remains high risk. We're starting to see a little bit more encouraging signs. Like I said, we've got this pattern. Looks like it is starting to be what you can officially call an inverted head and shoulders pattern. Now, again, I measured this target yesterday and said that from 128 to 134, which is the height of this pattern, you can take that, add it to the breakout point, it will give us a target of 139. I'm skeptical that the market can do that, but again, it pays to always be flexible and have an open mind. Don't get locked into any one belief. But if you're believing that this market can rally, it remains high risk because the primary trend is lower. It's going to have to get above this high from Monday near 133.80 or so. Getting back above there, that pretty much completes this inverted head and shoulders pattern. I don't think it means we've got a straight run up to 139, but what I do think it means is that we could potentially see a little bit further short squeeze rally develop, and that we can start to look at some of these other levels where we've seen resistance prior. And we could take a look at Fibonacci and say maybe if we take this sell-off from the 26th high to recent low, well, we've seen a 50% retracement of that. Maybe we head towards the 2/3 retracement up near 135. If the market gets up to 135, that's where it's going to meet that declining 50-day moving average. So we've still got a very mixed picture. I'm going to repeat myself by saying that only the most aggressive, disciplined, and experienced traders should be involved in here. You have to be quick to adjust your thinking in this market. Yesterday we saw resistance, where we were kind of expecting it with that declining, or with the average price since the January lows. But now it's maybe going to run back up and test that level again. So again, a lot of mixed messages. The XLF was down only a penny today, and it had come down and made a lower low, in fact. So this market continues to be very volatile. Yesterday we saw that this market pulled back more than the other ones. As it broke through this, what we were thinking might have the potential to be support at this prior resistance here. But again, I had warned, don't buy just because it's pulling back into a level that should be support, because you don't know till after the fact what support really is. So the market flushed out some sellers here on the open. It recovered quickly. You can see that where it got back above the daily VWAP right here as it moved above with some big volume. And that pretty much set the tone for the rest of the day when that big volume came in and buyers took control of the daily trend. Now this market took a lot more time to get back above, and it's not convincing holding above that average price of the last 3 days. So this market, the XLF is still somewhat suspect, but it is back above that 5-day moving average, which is flattened out. So it's possible we could see a rally materialize from here. But again, an eye on the bigger picture still reminds us that the 2620 level that it broke down from is an important level, and ought to be most likely some resistance in that area. If we take a look at the average price since this market made its this first low right here in January, the average price has been at about let me take a look. I'm gonna get my trend tool back. This level here is at about 2665, and again we've got the declining 50-day moving average coming down to test that. Remember, it's the direction of the 50-day moving average. A lot of people get tricked into buying markets when the market moves back above that 50-day moving average, but the direction of the 50-day moving average is more important than a close above it, 1 or 2 days. And we've got that 200-day moving average. It's also telling us, obviously, this market remains in terrible shape. It's still guilty till proven innocent. Nothing has changed there on the longer term picture. The trades, again, I'm going to repeat that any trade I mentioned to the long side is high risk and ought to be traded very aggressively. You have to be quick to move in and out. I was in the QLD today, but for a day trade, I was in and out of it. There's no reason to continue to allow that kind of risk. Now the IWM, this market is looking really very interesting to me. If you consider the average price since the January lows in here, it's about $69.12. And again, that's where, if it takes 2 days to get there, maybe that 50-day moving average comes down to meet it as well. So we've got two potential reasons why we might expect to encounter sellers there. So we can't get too excited if the market gets above this key level that we've been talking about at $68 a share. $68 had been a very important level for support, and we saw a test of it back on Monday, or actually rather yesterday, of that $68 level. And the market came right up back to it today, but it's holding very nicely up in this range. And we've got all these moving averages now lined up nicely with this red above the blue, above the green, and then we've got the 5-day moving average moving up as well. So this is looking a little bit more encouraging. Ideally, what I'd like to see, and the market doesn't always do what I want it to do, but I'd love to see it pull back to 67 or so tomorrow morning, create a higher low, and then as it begins to rally, buy that strength here, see it push out towards, past $68 a share, then maybe head for this next level of 69. But again, it's likely this market will encounter significant resistance as it attempts to rally from here. Maybe it ends up being a bottom. We'll know in 6 months, but I'm not willing to bet any long-term money that it is. You've got to take this market very slow. in terms of committing to a longer term turnaround scenario. The Qs have a very important level of resistance just above as well, and that level here, looking at the 10-minute time frame, is 43.50. That pretty much defines the inverted head and shoulders pattern in this market. And this market, we can take a look at this. The height of this is about 41.25 up to 43.25, so that's 2.25 points. That would give us a price target of would that be about 45.75 or so. And again, it's tough for me to believe that that could happen. This 50-day moving average is at 44.75, and if you remember, this level here, 44.50, was very significant a couple weeks ago as resistance. So this level, 44.50, is likely to be an area where we're going to see significant resistance if this market rallies. So don't look at this upside objective from the inverted head and shoulders pattern. Look at that blindly. You can't do that because the it's a short-term pattern that indicates some bullishness in a primary downtrend. So we've still got a very mixed picture. What we look for is trend alignment. This is not an aligned trend. This is a short-term move against the primary trend, which makes it high risk.